So obviously this was a hotly anticipated budget, I'm sure you'll all agree. And if you monitored the press in any way, literally anything could have happened, yeah? Had all of the predictions and leaks happened, who knows where we would be. So we probably anticipate a lot of things. What actually happened though, and I think the answer to has Reeves killed off buy to let is probably no. Certainly not in the budget anyway. I think the budget was a mix of the good, the bad and the ugly, and I'm going to come into this. I'm obviously the good tonight. Bruce, oh no, it's the council guys up next, isn't it? So I'll stand here so there's no doubt. And then, sorry, that was cheap, wasn't it? That's clearly Bruce and Paul. So, right, what did we have then? Well, the good. What was the good? So this is just for landlords initially. What was the good? Capital gains didn't change for landlords. So I've got to be honest, was staggering. I thought any change in capital gains we would at least mirror, if not be worse. What actually happened is everyone else got our rates, which I think was a big surprise. Nobody was expecting that. Nobody had that in the drawer, did they? Section 24, unsurprisingly, is unchanged, but was no worse. The restriction of finance charges. So individual landlords who are higher rate with resi properties and mortgage interest don't get full relief for it at the moment. They get a 20% credit. I predicted at the all-day event, if they really wanted to get loads more money off landlords, they would abolish the rest of the relief, or they would start to cap companies to only get half of the relief, which would have made a big difference. It would have raised quite a lot of money. They haven't done that. And then also, I did also speculate at the all-day event that they could change other reliefs. So there's two easy ways of increasing tax. You change the rate of tax that you pay on the thing, or if you have a relief that exempts a thing from charge, you can actually scrap the relief and probably still argue you've kept your manifesto pledge because you're not changing the rate, you can just scrap a relief. Most of the reliefs that are used by landlords haven't gone. Nothing new went. So overall, I don't think it was too bad. Someone disagrees. The bad, is this terrible? I think 2% extra on stamp duty. It's not great, but if you're honest, you probably were thinking it would be worse. There was almost certainly a lot worse speculated. And then snuck in there, you've heard me bang on about making tax digital long enough. I know some of you are absolutely all over this. Got no problems at all with this, all squared away, sorry. You will be soon. What was actually hidden away, not hidden away, but it was in the fine print. From April 26, if your gross rents are more than £50,000 and you're an individual, you have to do quarterly updates, quarterly tax returns. From April 27, if your income is more than 30, and this isn't the profit, this is the gross income, your rent. If it's over 30 grand from April 27, you have to do quarterly updates. And what they've now said is by the end of the Parliament, it'll be a threshold of 20k. Now, I don't know if they were setting that as a challenge to end the Parliament or not, but if we assume it'll run its normal course, within 5 years then, anyone with 20k of gross rental income will have to do quarterly updates. This is just for individuals, not companies. But I reckon if you put a bit of inflation in from now till then, 5 years from now, this is most people with 2 properties and probably everybody with 3 properties, which is then almost every landlord. Not every, but almost every landlord. It's worth stating that if you've got self-employment income as well, the same thing applies. So if you're a self-employed carpenter, mortgage broker, whatever you are, this 20 will also apply by the end of Parliament. So you'll have to do quarterly updates. It should make it easier when you're doing mortgages because people should be up to date, but we'll see what happens there.
None of the lenders got policy for it yet?
We'll see what happens. I'm not sure there was any real ugly stuff in there for landlords. Yeah? We only got the stamp duty increase and MTD coming forward slightly. I'm not sure that was too bad. If you've already got 60k worth of gross rents, MTD hasn't changed for you. It's coming in when it was coming in anyway. So what else is there? I was just going to say thank you, but I don't like to let you off. We're going to do some revision. Do you fancy some revision instead then? No one said yes. I might just go, right, who's next, Ed? No. Right, stamp duty is still due. Now, what I think might happen here is people might say, 5% stamp duty, I've got to get out of this somehow because 3 was already bad, and I don't mean stamp duty in total, I mean the additional charge. If you've got deals that don't work for 2%, bear in mind property is normally a long-term game, I would say most people should be able to plan in that 2% over the 20 years you're going to plan a property. I'm not sure it's material. However, we've already got an unbelievable amount of people falling for online scams that promise to get you your stamp duty back if there were pigeons in the roofs of properties and those types of nonsense things. So just as a reminder, stamp duty, land tax is almost certainly due if you buy a property that is a dwelling, because in short, the judges on various cases have said, well, a dwelling is a dwelling. Doesn't matter if it had no electricity, if the kitchen was broken half, it could have asbestos, it could have been condemned for almost every other purpose, but if it was still really a dwelling, it's a dwelling and the stamp duty is due. Now what's happening is people are getting refunds from the Inland Revenue thanks to claims companies. You pay most of your fee or at least a third of your refund to the claim company who disappears, and then a year later the revenue say, we're just going to have a look at that, is that all right? And they don't care that you've paid some of that away, they'll get the stamp duty back plus penalties and surcharge. And just as a throwaway, if you owe the Inland Revenue money, it's now going to go up to 9%. Might have gone down with the base rate drop today, but 9% is a decent amount of interest to pay HMRC on outstanding money. So you definitely don't want to get them coming back after the event chasing money. We're still getting questions all the time about companies. Nothing has really changed. Those of you who were on the online one in April 21, it was a good night that night, wasn't it, in April 20? No. There's a webinar on the hub that goes through. That was a good, I thought I did well on that webinar. There is a webinar that talks through the different taxes between individuals and companies. The rates have changed slightly since then because the CGT is lower. SDLT 2% on, but since I did that, we've now got lower CGT. I think it's worth still saying that you have to weigh up all costs. And I know now the lending rates are becoming a bit more equal. If I'll let you worry about that, Paul, when you talk to them next. But it used to be, 9 years ago, it was much more expensive. You needed bigger deposits, the fees were higher, and people weren't weighing that in when they were doing the tax review. But it was never just a tax thing anyway. It was always a what are you up to thing. Companies have got a lot more admin. Company directors have got legal responsibilities for certain activities that you don't have if you haven't got a company. And again, I think a lot of people underestimate what those are. And what I always say to people is, what's the plan? So if you said, can I have a simple, single answer to company versus individual? I can give you 2 simple examples on each of the extremes. As soon as you have a non-standard plan, which is the number of properties, how you finance them, what loan to value you've got on there, what rate you pay, what your personal circumstances are, you have to weigh all of those things in before you can say if you're better or worse. I'll go through some of this. I'm not going to there's 2 slides and that's as many figures as you're going to get on them. But what you can see is, this is a landlord with 60k of rent. So what's that? I don't know, 5 properties, maybe 6 properties, but it doesn't matter. It's 60k of rent, 20k of interest and 10k of expenses. So we've got someone who's made cash 30 grand. Yep, we can all get that. Basic rate taxpayer, nothing to worry about. They just pay 20%. Their take home, they lose 6 grand of the 30, they've got 24 in their pocket, nice and simple. If you higher rate, you don't get full relief for the interest you pay. And the way the maths works in this example is, your tax bill is 16k, which is actually a 53% tax rate. That's the bit people don't like. And they say, well, what do I do about that? Well, if you're in a company, and let's say you're paying the highest rate in the company, it's 26.5%. In theory, the initial round of tax on that is better than the 14 you would have kept. You keep more money here than you would if you were a higher rate taxpayer. You'll note it's less than if you didn't need a company at all. So basic rate, definitely you don't need a company. It's almost no reason to ever have a company for basic rate. If you're higher rate, this £8,000 differential is useful, but it's worth bearing in mind it only exists as long as you leave the money in the company. Once you take the money out of the company, you'll see the difference is only 600 quid, and any accountant will charge you more than that 600 quid to have a company more than a tax return. So if you want the money out, you're almost certainly no better off, and if anything, you're probably worse off. And that's before we look at the capital gain, okay? I love when all of the slides will be on the hub there. Just yes, unless you're taking pictures of me, I won't be on the hub. So what have we got? If the important thing for you is rolling up your after-tax rent to get the next deposit, as an example, you'll save it quicker with 22 than you will with 14. You'll get there about 50% faster, okay? If you need the money out, as you can see, you're no worse off, no better off, sorry. It's basically neutral. What about capital gains though? So let's say these were properties that we've bought for 50, spent 20 grand on them, we've remortgaged out, we've got the money out using the B or model, right? We've got the money out. The 20 grand was probably a revenue expense. That was probably allowable against the rental income. So if we then look at what the capital gain scenario is, we've made 50 grand because it's worth 100 and we've bought it for 50. What happens? Ignoring other income, etc., just assuming pure rates, the basic rate you pay 18%, you keep 41, which is really nice. There's a higher rate, you pay 24% and you keep 38. The company will pay 26.5, assuming its income is over 50 grand, which means the company has already got a lower take home and the money isn't yours yet, it's the company's. By the time you take that out, what you'll see here is on that 50 grand uplift, you're actually £14,000 worse off by the time the money is yours in your hand. Okay, so let's run some quick numbers. Let's assume we've got a day job, a higher rate, and we also want all the money out the company. We could have set a property company up, done all of this, and not really been any better off because we took the money out. And then each property we sell and make 50 grand on, we lose 12 grand of capital gains at the back end. Now, so you're worse off for tax, assuming you take the money out. You haven't got to take the money out, but this is why you need to know what the plan is, okay? And I'm ignoring the fact you can take money out at basic rate until you get higher rate. I'm just assuming pure rates for simplicity. So you might say, well, why would anyone do this? And it's a reasonable question. There are still good reasons to do it. One good reason is, remember you had more money each year to put into the next one. Well, if this gets you a portfolio of 30 houses instead of 20, because you saved up 50% faster, then even though you might lose more capital gains tax, you had 30 lots of 50 grand to start with instead of 20. If that's your plan, then it might still work. Or you might not need to take the money out ever, in which case, fine. But it's, what I'm trying to illustrate here is, and watch this on the hub and make sure you can actually track the numbers, this is the most important part of it, the plan, not the tax. The tax is actually relatively straightforward to calculate out. The problem is when you do your scenario planning and you say to someone like me, what will happen if I'll say, well, I can answer that. Is that what you're going to do? Or might you do one of 50 different things? Once you figure out what you want a scenario plan, it's actually quite easy. Working out what your plan is the hard bit. Just also a bit of revision, the furnished holiday let rules are gone from April 25. That didn't get through the Parliament before the election. It is now going ahead. Inland Revenue calls these furnished holiday lets. You might call them SAs, Airbnb, short-term lets, whatever you call them. The revenue calls them furnished holiday lets. This is typically houses where people stay in them for less than 28 days. It's holiday homes, Airbnbs. So that is confirmed. You've probably also seen me, I think when I tried this here, it was a disaster because the internet didn't work, but I've done, you can watch it on the hub, 10 tax things all landlords need to know. This 3 out of 10 is the average score people get when the internet works. and I can actually track the answers. The highest score I've ever had on this was a guy who'd seen the talk 3 times and he still only got 6 right. And some of you know him. I know you know him, Rosemary. I know there's some people who know him. And that was the 3rd time they had seen it in about 8 weeks. Why did I put this on? I think we spend so much time as landlords keeping up to date with all kinds of legislation. And sometimes some of the basics are just missing. Some of the real basics. There's a lot of things that happen. I think Charlotte will probably mention trusts. If she is going to mention trusts, I won't touch them. But there are still nice things that can be done with trusts. You've normally got to give away the asset and not keep your hands on it, which I'm sure Charlotte will cover. There's also some nice things you can do with family investment companies. Are you covering these at all or not? So a family investment company might be, you've got a property company, you might have 100 shares, and they might be all yours, they might be 50-50, whatever it is, that's fine. So there is a way you can actually carve off a different class of share where its value is only the future growth in the asset. Now what does that mean? Well, if you've got £1 million worth of property in a company, we haven't solved the IHT on that existing million, but the future growth is attached to a new share class that you can put in a trust, for instance. Once that's in there, the value on day one is very low because all it has is the future possible growth. And of course, the longer you live and the more we get growth, that growth is outside of your estate for inheritance tax. It's actually quite good. It doesn't solve the original million. You need another plan for that. But don't forget these exist. You see these called all types of things, but again, we can cover this off if it's something of interest. Ugly. I've put a couple of uglies in here now. They don't directly affect landlords, other than they will very soon affect landlords. Ers and I, there was the debate about who's a worker, who's not a worker. I don't see any workers in the audience, none. I know there's 2 people on salaries from the council, but sorry. To be fair, Graham, I don't know you well enough to make that joke, but Ed, I stand by that. I'm teasing, obviously. Right, so what's a worker? Well, we still don't know, because literally within days of the budget, Rachel Reeves and the Business Secretary, Jonathan Reynolds, both admitted that the employer's national insurance is just going to go straight off next year's pay rises for employees. And of course it is. I was with a client this morning who got an email that his brother had sent him that basically said, due to the recent budget changes, there is now a 2-year pay freeze, which I thought was a bit knee-jerk. And this was a fairly large employer that have sent that to a lot of people. We as a business, this cost alone is over £70,000 to our business, which we either have to pass on to customers, take off payroll, or take a hit to profit. Well, any good business tries not to do any of them. You try to find a way to do other things. So we're already doing a lot of work with this, but there will be, I think the OBR has said 60% of this will be passed on to workers via lower pay. Why am I telling you this? Tenants are probably the people that will be affected. So watch out for tenants not having as much money going forward. Also, there's a new COVID commissioner being announced. Everyone dead excited about that? No? Well, we all know there was a lot of fraud went on. Why am I mentioning this? I know quite a lot of landlords that claimed bounce back loans. Don't nod, I don't want to know. That shouldn't have claimed bounce back loans, or they shouldn't have applied and got bounce back loans. If I was the COVID commissioner, I would just go through every SIC code that says it's a property company, and I would ask them for the bounce back loan to be, I don't know what they're going to do, they'll probably wash it out at a higher rate, because you shouldn't have got the discounted rate, and they'll probably ask for it to be repaid straight away if there's even any outstanding. So it'll be interesting to see where they go on that. But I certainly know there was a lot of people who got bounce back loans that shouldn't have done. I know one person who I know had 10 companies and they got 10 bounce back loans, even though 8 of the companies were dormant. I would start there. They're not a client and they're not in the room, so don't worry. But if I was them, I would be wondering how long it'll be before I get the knock. Why?
It's worse than that because...
I wasn't finished, but go on.
Sorry.
No, go on.
It's worse than that because we're dealing with a well.
Yeah.
So if he's taken the money out, he wasn't entitled to it. Certainly the dormant companies are fraudulent, so he's got a risk of going to prison as well.
Absolutely. It's practically theft. I don't know if you would call it theft. I know the legal definition matters, but you've taken money out of a company it shouldn't have had that you fraudulently claimed, and you shouldn't have took it because that's not what it was for. So I think there'll definitely be a lot of this. Now you might say, well, I'm a landlord and I didn't do this. Great. How many subbies, trades, businesses are in your properties where they will be getting knocks on the door? I think this is relevant. It will come in. So the reason the rent might be late is they've had a visit off the COVID commissioner. I'll be interested to see who first gets that excuse. And then also, there is now a fraud, error and debt bill. I thought it was quite interesting. I was watching Ed Bowles and George Osborne talk. I think it was George Osborne, he said, oh, it was quite interesting for a Labour budget. The word poverty was only mentioned once. There wasn't really anything about lifting people. I'm just not here to make a political statement, but you would have expected that. But actually what was in there is a new fraud, error and debt bill that gives them some fairly interesting powers, including the power to look at people's bank accounts if they suspect they've been guilty of welfare fraud. So that's quite interesting because you normally can't just look at people's accounts. That's what this bill is going to do. Now again, without being too kind of like stereotypical, who is this? It could be our tenants. But also, the wider point, I think this is quite an interesting thing to sneak in under the guise of, well, we're going to stop these criminal gangs filling all the welfare, right? Okay, we won't all get behind that. But actually, this is now a sneaky, well, now we've been looking at people's bank accounts without having to get permission or court orders or anything. What else can we use it for? Yeah? You're not worried, Rosemary. You're okay. Oh, it is terrible. I thought you were worried, though. No, you should. You've got no reason to be worried. You say you're fine. Don't worry. And that is